G'day expats and welcome to another episode of Expat Chat, episode 74 today. And as always, joined with my friend, colleague, business partner and mentor, Brett Evans, who is in the biggest sandpit in the world, I guess we could say, who is the managing director for the EMEA region. G'day, Brett. How are you going, mate?
Mate, all well in the sandpit, all well in the sandpit. We're enjoying some nice fair weather at the moment, which is good. As we were walking the dog last night, family were complaining about how cold it is. And I'm like, in 4 months'
Oh,
time,
jeez.
you are not going to be complaining about that. So soak it up. I was.
Yeah.
And for the folks out there who don't recognise the silky smooth voice, is James Ridley. He's joining me today. He's the managing director of the Asia Pacific region, looking after folks in Asia and the Americas. G'day, James.
G'day, Brett. And I mean, I should clarify, everyone who is listening, the EMEA region, it does stand for Europe, the Middle East, and the Africas, as always. There's too many of them. But, mate, today, a couple of good topics. And I think you and I have both seen the amount of Australians that are heading abroad. Just seems like, obviously, we're in a post-COVID era now. It still exists, but in certain industries, the demand for labour has just ramped up significantly. I know the Middle East, it's quite significant. There's a lot of people right now that I'm talking to that are heading to the United States in certain occupations. Canada's actually been a big one, surprisingly. Singapore. Uh, it's interesting to see that there's just been this big ramp up, whereas we had a huge contraction through COVID, naturally, because of obviously all the relevant border restrictions, those sort of things. But I thought today we deep dive a little bit into, this pre-departure hypothetical checklist. What are things we should be considering before we leave and actions we can take to prepare ourselves from a financial aspect, from a tax aspect, even just from a personal aspect, insurances and other things. So wanted to deep dive a little bit with you, pick your brain a little bit. Before we get into that though, mate, let's get that little disclaimer out of the way.
Mate, all the information that everyone's going to have the pleasure and the privilege of listening today should be treated as informational and educational purposes only. Please treat it as general information. And if you need any personal information that pertaining to you, give us a call at Atlas.
Gosh, mate, that's silky smooth. You got that down pat now, which is really good. I've got to have a crack at that probably the next episode and see me waffle about.
We've said it a few times, haven't we?
I'll have a crack next episode to our listeners and you watch me stuff it up.
Can we get a scoring system from the listeners? We want the scoring system.
We could probably put the call out. I think a few of them would put shit on me, but that's okay.
Yeah. G'day, Rick, by the way. He's your client, but he's on my team.
That's right, mate. I mean, today, pre-departure checklists, and it's mainly just a really important hypothetical checklist and things that we should think about before we head abroad, before we become an Australian expat. We head into that new country or domicile. We have to put up with a new country's tax regulations and things we should consider with maybe our assets back in Australia, maybe the insurances we have, electoral roll, do we vote, Medicare, all these fun things. So I wanted to talk about that and just run through a bit of a general list.
Mate, let's do it. Let's do it. I think there's a lot of folks coming overseas. I think and all the people have approached this office in this week, I would say 60% of those people would be Australian domiciled, about to head overseas with varying time frames from this weekend to 6 months' time. So, and there's a lot of commonality in those questions. What do I need to know? They don't know what they don't know. What do I need to do before I need to go? What can I do after? Their laundry list of things to do when you're about to move countries is quite long. So quite often we can help people say, look, don't worry about doing it now. Once you get overseas, you can take care of that later on. So, mate, let's start running through that list and giving the good folks some information.
Yep. So, I mean, generally speaking, remember, if we are making a permanent move overseas, we are essentially going to be cutting ties with Australia, and it's very likely that we will become a non-resident of Australia for tax purposes. So even just little things, when you look at from a personal finance side and we look at even our credit cards and our bank accounts and those sort of things, you're not going to be maintaining, your Vodafone mobile plan. That's maintaining a significant tie, I guess you could say. Some expats like to keep the number active, and there are ways that you can contact, say, that particular provider and keep that number on hold. But just those little things, ending your subscriptions, because you'll be in a new country and you'll be able to sign up for more of those. I think one of the main ones when we sort of look at different categories is what to do with certain assets. I think the main resonance, Brett, that probably comes up a lot. Should I sell? Should I sell it when I'm overseas and I'm set up? How's that going to be treated? Should I rent it out? How's that going to be treated? Making those hard, uninformed decisions can lead to, I suppose, worse off results and have significant tax ramifications.
No, you're spot on. And I think the main reasons, because it takes the longest to do, like it's not an email you can do, or there's lots of little jobs you can do quite succinctly, whereas, folks aren't aware of that. They might be heard of the 6-year rule when they're living in Australia, the main residence exemption, but they're unaware of that they're not able to access it overseas. So that's a big decision that, whether it's a single or a couple together have to make. Is this going to be our forever home? Are we going to return to this house in Australia? Or, how does that look? Some people have no emotional attachment and they've always been looking for an excuse to sell. Property's on the way down right now. So maybe we, look at selling it. But, certainly with the main residence exemption, like I said to 2 people yesterday, if you do move overseas, sell a kidney, just don't sell that property, because it is the most punitive tax that expats face, in that you will pay capital gains tax all the way back to the date of purchase, not the date of departure.
I know it's very draconian, and it's even one of the Q&As that we're going to answer today, actually, about main residence exemption and estate planning matters and those sort of things. But it's often a case where we get set up overseas, we're now comfortable, and we might want to release that capital out of the main residence exemption, sell it, pay off the mortgage, bring the capital across to our new country, and potentially buy property locally in that area, because we're now comfortable and we want to start nesting in that area. We want to stay there. We're committing to, maybe 5 to 10 years, and rather than paying rent, we'd rather obviously be paying a mortgage and maybe paying off an asset. So that's often the conversations that we have, and sort of the scenario in the hypothetical case study that plays out. But as Brett just put it, you're not benefiting from the main residence exemption when you sell it as an expat anymore. You're paying tax all the way back to the date that you purchased it. Pro-ratering, not really probably in existence too much anymore in terms of a 50% CGT discount concession, because that went back in May 2012. And again, we're nearly at, we're past 10 years that now. So, geez, I forgot it's 2023 then. How bad is that? Jesus,
Yeah.
we're moving quick. But that's a really common one. Assets, what to do, how they're treated. I think bearing in mind, probably the other common one on, I would say, direct shares, managed funds, ETFs, deciding whether to opt into deemed disposal, or whether you're hitting sort of the sell all and cleansing the portfolio and starting and resetting the portfolio. So that's a really important one. Brett, did you want to elaborate a little bit on deemed disposal?
Yeah, so you need to demarcate the residency, not of just you, but also to what we call non-taxable assets. That's digital assets, shares, managed funds, and ETFs, and those sort of things. And what it means is, when you're an Australian tax resident, fingers crossed, you've made some money, the shares have gone up in value, you need to sever ties of those shares as a tax resident to becoming a non-resident. So what it means is, essentially, you can do, as James said, you can just sell down the portfolio, cleanse it, put it to cash, you pay the capital gains tax that's due in that financial year of sale, and then you can repurchase back that portfolio as a non-resident, not accruing any capital gains tax. Option B, when you do your tax return for that year of departure, you can elect into doing deemed disposal, which means it's a paper sale, in that even though you haven't actually physically sold it, you look at the price of the shares on the date of departure, you estimate what the capital gains tax liability you've accrued up until that point, and you essentially elect to the ATO and say, hey, I've on paper made this gain. I would like to pay the tax that's accrued up until this point, and then they'll send you a bill, and off you go from there. Do you want to run through what happens if you choose to ignore deemed disposal?
Yeah, well, unfortunately, it does mean the shares will continue to be taxable by the ATO, even though you're not living here anymore. And I suppose the ramifications of that mean that you could continue holding the share portfolio for maybe another 2 or 3 years for that time overseas. And if that portfolios continue to go up over that period, you are unable to apply the 50% CGT discount concession. So as an example, let's say you're leaving and heading abroad. At the time that you leave, your share portfolio is worth 100,000. By year 3 of you being overseas, it's now worth 30,000. And you want to sell it down. That 30,000 of capital gain that's accrued whilst you've been a non-resident, you can't discount that by 50%. And your marginal tax rate that you're paying on that is actually 32.5%. So 1/3 of that capital gain that you've made just for that period that you've been abroad, you're paying very high tax rates on. Further to that, you didn't do deemed disposal. So the capital growth on that entire portfolio is also being taxed at a minimum of 32.5%. So it's a very punitive tax for non-residents. When if you are going to opt into deemed disposal, I guess probably the hardest conversation that we have is, well, are you really committing to this move overseas? If it's only going to be a 1 or 2 year stint, you're sort of asking the question, do we do it? Do we not do it? If you know it's a permanent move, 3 to 5 years, often the case that deemed disposal is in your best interests. And I think Brett and I can testify to that when we've unraveled a lot of issues with clients before in the past. But it just goes to show that when it does come time to head overseas, it's important to get good tax advice. A lot of normal traditional tax accountants that don't deal with expats, they've never heard of this concept of deemed disposal. It was back in their studies 10, 15, 25 years ago, but they've never actually had to do it. So it's not something that they'll often raise with you when you might be doing a bit of a tax briefing before you leave. So it's an important takeaway there. Deemed disposal, a very important pre-departure checklist item as to whether you're doing it or not. I think when we look at other, I suppose, important aspects as part of a bit of a pre-departure checklist, well, you're heading abroad, very likely that no one's going to be contributing to your super fund anymore. So if you're someone that has collected a few super funds, well, it would be a really good time to conduct a review and consolidate them, minimize, additional product fees and insurance fees by having them spread across 2 to 4, put them all together, review the asset allocation, review the actual investment strategy, knowing that you might not contribute to it for a few years, and probably also review the insurance. It's one thing that we do time and time again for our clients. When you look at insurances within super funds, a lot of them do not cover you when you no longer meet the ordinary definition of an Australian resident. And it does mean you are just having an additional fee within your super fund account add into your balance for no reason.
Mate, spot on. And I think that's, people don't realise that a lot of times with admin fees for super funds, it's either a fixed or a percentage fee on the admin fee. And the fixed fee is normally a minimum. So if you've got lots of little balances, you're paying the minimum admin fee across all of those balances. Whereas when you consolidate into one, you either get to just pay one minimum admin fee or a percentage. But I guarantee it's going to be a lot less than having all those 4 being paid out.
Yep. And I mean, a really good example of a recent client that came on, they're in an old super fund and they don't have insurance within their super fund, yet they did have an old insurance policy and they're still getting charged by an insurance provider. I won't name and shame, but they're still getting charged by the insurance provider as part of that super fund for admin fees, yet they're not getting charged insurance premiums. So it's a case where, well, why are they charging these admin fees where there's no insurance? Something's gone wrong there. So we'll have to help that client to get actually a bit of a refund there. But that's just a bit of a case why it's important to do a bit of a review when you head overseas, because often a case that insurance won't cover you. Another important one, talking about insurance, private health insurance. We're not here in Australia and non-residents don't have to worry about the Medicare levy. So it's often a case that because you're not here, you're not going to be using any sort of private health insurance benefits, don't need to really worry about rebates or anything like that. You'll often put that private health insurance on hold for as long as you can. Generally, most private health insurance providers will give you up to 2 years. Some will do actually 3 years, which is great.
I actually heard 4 the other day. Someone did 4 the other day. So, I think...
Okay, that's pretty impressive.
But it wasn't like a mainstream Medibank private or HCF, that sort of stuff. So
niche. Yeah. And I mean, that's really good. You're in the system still. Often it's the case, you're not going to be coming back and using it. I've heard sometimes the case that some private health insurance providers, they'll allow you to pay a month or two's premium and use those benefits when you're back. But I mean, you probably won't need to. But yes, putting it on hold is important. And what's important about putting on hold is also a case that when you return to Australia, a lot of people will naturally go back. They'll get their new private health insurance because generally they're over 30. They may be a bit older, 45, 50. They've had a family and they've come back and putting themselves back in the Australian system. The lifetime health cover loading automatically gets whacked onto their insurance premiums. That takes 10 years to remove off your premiums. often it's the case you actually need to provide your passport history to show that you've actually been out of Australia for that period. So
Yep.
that's an important one. But generally, you're not going to be here. You're not going to be able to claim on private health insurance. So that should be put on hold for that time that you're overseas. That's an important one.
And just want to just take 2 steps back as well too. Just something dawned on me, well not dawned on me, reminded me a call I had this week. You said the importance of getting good advice, but advice that from someone actually knows what they're talking about. So this couple, Sydney-based, about to move to Abu Dhabi, and they went and saw an accountant. They thought they're doing the right thing, and this accountant virtually scared the bejesus out of them and said, you have to scorched earth all of your worldly possessions in Australia, including your bank accounts. So these people walked out of there really confused because they have 2 investment properties, and they're like, so do we have to get our tenant to pay their rent into our Abu Dhabi bank account? Like, it's like, no, you can maintain.
Would have caused a bit of a panic, wouldn't it?
That's why they reached out to us, because that didn't pass the sniff test. They said it doesn't sound right. So certainly when you are reaching out to people, pre-qualify them in terms of how much experience they have in dealing with expats. If it's once a year or never, then move on to the next one. You don't want to waste your time and theirs by going through a situation where it may be, maybe sort of scenario. You want clear, unequivocal answers.
Yeah, absolutely. I remember a few clients that came on board about 4 years ago. They said, James, have you heard about the 7-year rule? And I said, no, I haven't actually. Yeah. Good one. I was like, you're going to have to tell me. It's like, well, it's something our client communicated to us, that we have to be out of Australia permanently for at least 7 years in order to declare ourselves as a non-resident. I just said, exactly. I was like, that's made up, actually. I've read the boring 1936 Tax Act. That's not a thing. I said, you need to change accountants pretty quickly because I don't know where that's been pulled from. But there is no sort of rule, a 7-year rule. But it does show, seeking advice from those that actually work with expats is paramount, just in case you rely on the advice of someone that doesn't, and you act on their advice and you end up selling something that you shouldn't have when you didn't need to, just all those sort of things, ramifications. But moving through it, mate, I mean, I guess another important one about pre-departures checklists, and it's often a case where a lot of my clients in the US, they get hit up by the banks. ComSec is probably one that I'll name and shame. If they're in the United States, and when certain share platforms or investment platforms know that you're overseas, especially the US, they'll send you a funny letter. Yeah. And I mean, and they'll send you a letter, say, listen, we know that you're in the US. We don't comply with CRS. We can't actually service you anymore. Therefore, we're going to start restricting your account. And often it's the case that they try and give you a bit of a time frame to get off, and then they'll look to close down your account. So therefore, your shares are now just maybe on a share registry and not actually a brokerage platform, which means it's very hard to actually sell those shares in the future and do much with them. So that's a really common one. Investigating the platforms that you're currently using before you head overseas to make sure they are compliant and they are happy to have an Australian expat or a non-resident on board. And taking that a step further, depending on where you're going, and Brett deals with this day in and day out, Europe, GDPR rules, and the UK, GDPR rules. Most platforms do not comply with GDPR rules in Australia. There's only a handful. So when they find out that you're actually in a European country or you're based in the UK, because the UK is pretty much just control copied it, they'll often request you to get off because they can't comply with those regulations. So researching the platforms to make sure they align with you being overseas and that country in question as well.
Yeah, and I think if you are talking to those platforms, you need to explain that you're not going there in a part-time capacity. Your actions need to map to that of becoming a non-resident, which is severing ties with Australia. Therefore, your relocation is permanent, and see what they say. I can tell you right now, ANZ, CMC, ComSec, NAB Online, Westpac Online, none of them do expats anymore for the reason that you said. CRS, FATCA, the compliance regime of these companies, it's just gone through the roof. So they're like, our profit margin on expats is so small, but our cost to service them is so high. And we had a gentleman relocate from Hong Kong to Dubai a couple of years ago, and thought he'd do the right thing, call up ComSec and say, hey, I'm now in Dubai. They had his Hong Kong address, and I'm now in Dubai. With no word of warning, they cancelled his chess in and converted all his holdings to his response. He had 40 holdings, about a $1.8 million portfolio. And then
Jesus.
their response was Link Market Services and Computer Share and all the registries, they're going to send out to you your blue statements by mail
Yep.
with the
That's ridiculous.
SRN on it. We don't actually have a mailman in Dubai. We don't have mail. So he then had to go around, go back to all the registries. And because they've done their legal obligation by sending a letter out that he never received, anytime you request your SRN to be sent to you, either by email or over the phone, you have to pay them a fee, up to $110 Australian per holding. So he spent a fortune just getting access to an SRN that he was entitled to because he's the owner because of ComSec's actions. So, yeah, be forewarned, forewarned is forearmed because, times that things can go sideways pretty clearly.
And I mean, data feeds catch up. And a really good example of this, and obviously not saying names, but a client that's in the Middle East, his Australian bank sent him an email and a letter saying, hey, we know where you are. We know you're in this country, but we don't have any details of that on file. The country in question doesn't have obviously any tax, so it's how do they know that I'm there? But banks sent him an email saying, hey, we need you to update your details because we know you are in this country. We don't have any tax resident details of you being in this country. Why? Can you please update it? So it's important that if you know you're heading to a certain country, that you do update your bank details, your financial institutions. It allows them to withhold the required rate of interest, withholding tax on your interest income. Share registries, as we said, there can be a bit of a hurdle and issue there, and it does happen, unfortunately. They will find out and they will know, even though you haven't told them. But it's also a case that if you don't update them, they're not applying the relevant withholding tax based on the income distributions or the dividends that you're receiving. So very important to make sure you're updating it and doing your checks there. Banks is a really important one. And I'll take that a step further with the banks. When you notify your financial institution that you are overseas or they know you're overseas, some banks will just start withholding tax on your interest income. If you haven't provided them with a TIN, tax identification number, or some sort of information about you residing overseas in the country, they actually legally required to withhold the highest withholding tax rate, which isn't 10%, it's up to 47%. It's the highest marginal tax rate in Australia. In the event they do that, you will get that refunded to you at the end of the Australian financial year when you lodge your tax return. But it just goes to show that they're not going to take the risk on you. So you should absolutely give them the correct details so everything is above board. That's a really important one. I guess another little pre-departure checklist item, Medicare. I mean, Medicare is always an interesting one. It's one that gets thrown around in a lot of the Australian expat forums and Facebook groups. I don't often encourage my clients to renew their Medicare card once it's expired after that's generally that period, because it's maintaining a significant tie to Australia. And especially if you're in a country which has a low income tax rates or it's tax-free, you don't want to give the ATO a reason. So trying to encourage just doing a mixed billing practice or paying for that private consult when you're seeing a GP back in Australia and you're going and filling your prescription, those sort of things. But you should actually notify Medicare that you're heading overseas because it maps well to that individual heading abroad for permanently becoming a non-resident. It's all these little data points which the ATO relies upon.
100%. And someone's not going to be deemed a resident for tax purposes just because they've got a Medicare card. But it's the actions that map to it that come back to the domicile test as part of residency. So, and this is where, this and the $10,000 rule are probably the two biggest expat myths that you get around, and it drives me nuts. But essentially what causes the confusion is Medicare rules are different legislation to tax rules. They don't interlink. So according to Medicare, and this is them saying it, you can move overseas and still use your Medicare card up to the expiry date of the card that was issued when you left the country. However, that is at odds to the tax residency rules that says, what does your domicile look like? What do your behaviours look like that of a Dubai resident? And as I say to clients here, would an Emirati use Medicare? No. So if you're trying to look and appear like an Emirati from a tax residency point of view, why would you risk it? You can use it. And some people, they like to get on their soapbox and they'll say, oh, so I'm entitled to Medicare, I've paid taxes all my life and all that sort of stuff. Have at it. Go for it. But don't come crying to me when they use that as well as other evidence supporting your, false claim that you're a tax resident, non-resident for tax purposes.
Yeah.
So it is the most confusing element of it. It's just, most expats will have some sort of health insurance as part of their employment, that sort of stuff. And what majority of the times it includes Australia. So when you go back to Oz and see the GP, just pay the full freight, claim it back, from your health insurance when you get home. Don't risk it.
Yep. And I mean, right now in Australia, gosh, the argument about GPs and GP practices and mixed billing and the rebate, it's a very interesting conversation that everyone's having right now. And I guess it's because there's less and less bulk bill practices in Australia because the rebate hasn't changed for 10 years. So it's kind of comparable to not getting a wage increase for 10 years, which is pretty hard to, I guess, weather. And that's why you've got all these mixed billing practices now rather than bulk billing. Another important one when we head overseas, is having a bit of a plan on how you're going to deal with foreign currency. And whether that's having a foreign currency account set up, say a platform account, there's plenty of good ones out there which do allow you to convert Australian dollars to US dollars or dirhams or wherever you might be, reals, but having a plan around that. So, whether it's a case you're setting up an account before you leave, on the common platforms that always get thrown around the traps with expats, OFX is probably the most popular, to be honest. TransferWise or Wise, that's another common one. Those are probably the most two that I often hear clients mention to me. And they're usually pretty easy to use as well. So remember, you're heading overseas, you might have to transfer some of your savings in Australia to help you get set up in that new country. So you want to have a bit of a plan of how to get it across. Relying on the bank in Australia to convert and send it over to your overseas bank isn't a good plan. And the reason why is you get charged a bit of an international transaction fee on top of the terrible FX rates that the banks will give you. And they make sometimes 5 to 7% off that kind of conversion because the rate that they're offering you is absolutely terrible. So have a plan on how you're going to deal with currency when you're heading overseas, whilst you're overseas, and when you're coming home.
Yeah, I think you're spot on, and I'm sure the bank's bonus pool is actually generated the majority from FX transfers by retail and clients because, as you said, it can be incredibly high, 5 to 7, and that may not sound like a lot to folks on the call. Work out how much you're transferring, times it by 5%, and then work out how much you're transferring, times it by 0.5%. That is the saving you will achieve just by going through a currency broker as opposed to going through your bank. Now, if you don't want money, give it to me. My daughters would love it. But it's you're just giving money away for nothing.
That's it. And I mean, in terms of some final little things to bear in mind when you're heading abroad as part of pre-departure checklists, we always mention, are you going to keep yourself on the electoral roll or not? And then notifying the ATO that you are moving overseas and letting him know,
that's a good one. Let's talk about that because that's come up about 10 times this week. How do you actually tell the ATO that you're a non-res? Go for it.
Well, I mean, most Australians that are in Australia right now, they should have a MyGov login, and ideally they've linked that ATO service as well. So you'll have a profile on that service, and you should be able to update your details on there as well to reflect the fact that you're heading overseas or that you're in a new country, such as the United States, Singapore, Hong Kong, China, Dubai, UAE. But that's a quick example. The issue that arises when you are overseas is we no longer get that delicious two-factor authenticating code texted to us because we don't have that mobile number anymore. So that's another important aspect. When you're heading abroad, you've got to remove the 2FA on some of those types of logins or update it to an actual authenticator app and have that app on your new phone or whatever it might be. That's really important.
Yeah, and the other option too that a lot of people don't realise because they don't really look at their tax returns too closely is actually a question in that tax return that says, did you become a non-resident at any time of this year? If so, when? If you become a non-resident on the 12th of February, you tick that box and say 12th of February. That's just giving them a heads up and say, hey, and we always talk about becoming an expat. It's very busy, especially in the first year. So it's so easy for that tax return to drop off and you don't do it. And then suddenly it comes a couple of years, later. It's important to get that first departure one done, just from a disclosure point of view, it says to the ATO, hey, James here, I'm out of here, chat to you later. They know.
Yep.
They're not mind readers. Yep. Yes, they are linked to the Department of Immigration, but you want to be on the front foot when it comes to those disclosures.
Absolutely. Absolutely. I mean, some final other things that I can think of would be, because you're heading abroad and you're still ideally on your current salary with your current employer and you're planning to move abroad, it might be a good time to have a quick mortgage review, because you're in a good position right now where ideally, yep, you're still earning your Australian salary. You're just still treated as an Australian resident. Yes, expats can get mortgages, not an issue. You just need to know the right providers to use. But you're in a good position right now to have a mortgage review before you head abroad and try and lock up a sharp rate. So just one of those other little things. I mentioned before the electoral roll, consider whether you're going to consider voting or not. That's always a funny one. Know that you're still going to have tax obligations back in Australia. Still have to do your non-resident returns. Still have to pay that HEX debt that a lot of us obviously usually still carry around the world or have already paid off, but can't escape HEX debt anymore. And that's why the ATO likes to know where you are or where you're going.
Yep. And that's the thing. It's the world's compliance has gone from being a nice thing to do to being mandatory. There's no... I say to everyone, she'll be right. It's not an approach to managing your financial affairs when you move overseas. 20 years ago, 30 years ago, 40, you just disappeared off the radar and the government had no idea where you went. Now, very different. There's the Common Reporting Standard, which is a global data sharing agreement, 150 territories and countries, including Panama, BVI, UAE, Luxembourg, China. Everyone is a signatory of this except for the United States because they got FATCA, they got their own version. So people freak out when I tell them. I said, the central bank of the UAE is sending details of your Emirates NBD account to the ATO back in Australia. And they're like, what? But, I didn't know that. I said, they've been doing it since 2017. So it's not like a new thing. It's actually been happening for a while. And I said, as long as your actions are mapping to that of a non-resident, you look like an Emirati, apart from wearing the Kendura and all that sort of stuff. But as long as your actions are mapping to that of a local resident, you've got nothing to worry about. But don't try and be clever. Don't try and think, I get away with this because nothing's happened yet. Anti-avoidance rule 4A, as you and I both well know, it can come back to bite you.
Absolutely. And Brett, I know we're getting on here, and I actually want to move us away from our current topic, bit of the pre-departure checklist. And I actually just want to throw out, the question that came in.
Thank you, Sue.
That's right. Sue, appreciate you listening and sending in this question and feedback. And and it's mainly around the main residence exemption, but talking about estate planning. So as an example, if an Australian tax resident passes away and through their will, the beneficiary of their main residence is a foreign resident or an Australian expat that's a non-resident living overseas, do they still get the relief rule of 2 years to decide whether to sell it? And what's funny is you go on the ATO website and there's a lot of different pages on this. And it goes to show that the ATO is very slow at updating things. And there's still some old pieces of legislation on there, which makes it very hard to pull apart what's right, what's wrong. But when we even jump back to when the legislation piece came out, and I guess the best source is usually the explanatory memorandum, to be honest. And one of the sections...
that's the law.
That's it. So I'll read out just so we have absolute clear guidance. So the example here is the deceased estate where the beneficiary was a foreign resident beneficiary. Again, so Australian tax resident passed away and the beneficiary of the main residence was a foreign resident, which is an Australian expat, which is a non-resident for tax purposes. So if the deceased was a resident of Australia for taxation purposes at the time of death, then the main residence exemption accrued by the deceased for the dwelling continues to be available to the trustee or beneficiaries of the deceased estate that have bequeathed the property. This includes exemption attributable to the period that occurs within 2 years of the deceased's death or within such longer period allowed by the commissioner. So that just goes to show that even when the beneficiary is a non-resident, they can still access the 2-year relief rule. The section that it's under as part of the explanatory memorandum is 1.38, and Sue will put the link in the YouTube notes just so you can deep dive into that a little bit better. But that is legislation. So that's where we look at. But yes, we still get that 2 years to actually access and make a decision. Thereafter, well, we're a foreign resident, so we can't access the main residence exemption because we haven't moved into it. We haven't established it as our main residence. So after that, that's when CGT can come into it. And it depends on how long you're holding that asset for. But that was a really good question. That's mainly an estate planning one. Definitely something to consider. Sorry, Brett, you go, man.
No, I was just saying it's not the first time we've seen misinformation, not misinformation, because that sounds like it's purposeful, incorrect information on an ATO website before. So, which it causes so much grief for people.
Listen, some would question some of the information on the ATO and whether it is purposeful. I feel like every now and then they're trying to get you, gotcha. But mate, as we wind up the episode, I thought I'd throw it over to you. Sorry,
before
mate,
we do that,
you go.
We've got another question from Andre. So let's just quickly hit that from Andre. So Andre's in Mexico. And he said, hi, first of all, when I left Australia 13 years ago, I inquired about my super and was told to abide by the rules as if I was living in Australia. He agreed. 13 years later, due to circumstances, I again inquired and told I'm not eligible to access because I don't live in Australia. If I'm not eligible, then the rules don't apply to me. So there should be a new set of rules for people living abroad and never returning to Australia that are eligible to meet criteria, e.g. terminally ill, not being told you're terminally ill, and seeing Australian doctors and so forth. So much more I want to say. I think what he's leaning on here is obviously what we call the early access provisions. And just to go to a high level for folks out there, super is agnostic to residency, whether you're tax resident, non-resident, the same rules apply. So I'm sitting here in Dubai, James is sitting in Australia. We both have super funds. We both have to comply by the same rules. Do I agree with Andre's comments about being able to access super when he severed ties with Australia? Yes, to a certain degree. You know, pre-2000, and I can't remember the exact year, I think it was 96, 97, if you said to your super fund, I'm going and bon voyage, yes, you could draw a super. That legislation was changed at the end of the 90s, and now you virtually have to present a kidney to get access to your super early. So while I do agree with it, the good news is you haven't lost it. Yeah, sometimes I say to clients, it's a blessing in disguise and that it's forced savings for you that down the track, it's there for you. Even if you never return to Australia, you never set foot on Australian soil. Once you meet the preservation age, you can flip it over to an allocated pension and then draw it all out. Could you use it earlier? Would it be beneficial? 100%. You know, I know I'm sitting here as an expat in Dubai, and if I could get access to my super, there's a lot of things I'd do with it. But in the same token, in the back of mind, it's like, it's great that it's there, so I know I can touch on it down the track. So, unfortunately, Andre, I don't think that's going to change anytime soon. There's been no inclinations whatsoever. So, I mean, it's funny these days, early access provisions, they tend to be getting looser. You know, people are getting dental work done and boob jobs and all sorts of stuff done by being paid for their super. So, if you're a non-resident, you can't touch it. So,
yeah, exactly right. And I mean, like as you mentioned, Brett, in the event you can touch it, you've sort of got to jump through quite a few hoops, criteria to access it. And then if you can, sometimes it can also be taxed. And that's sort of a DAS payment, which I recommend you pretty much essentially need to give back citizenship
half
to be able to do that.
And then give up half of it. Yeah. So,
good one. Really good one.
Yeah. So sorry to cut you off before. I just want to make sure we touch on Andre's comments as well too.
No, that's all good, mate. I mean, the last sort of question I wanted to throw over to you was just, as we did last week, just giving a bit of an example of a client we've helped in the last 12 months. I thought I'd throw it over to you because obviously last week was mine and this one can be yours.
Yep. This one I'll call the bloated offset account. So quite often, and this is either newbie expats who don't know what to do with their money, that is default to putting money into their offset account. An offset account is an account that runs parallel to your mortgage account, so that if you are paying 5% interest on your mortgage, you're actually getting 5% credit interest on the balance that's in that account. Quite often people just go, I'm not sure what to do, and they'll just put it on their offset account. And I don't know what it is. It's 2023, and obviously it's the theme of for the last month and a half. A lot of people I'm meeting had these bloated offset accounts because they just didn't know what to do with all the money, especially through COVID, but even post-COVID. So they've just been putting it in there. And I'm meeting a lot of people who have too much money in their offset account to the point where there's like $100 differential between their balance in their offset account and the size of their mortgage. Now, it makes you feel good. You know, inside you go, great, I own this property free and clear. If I wanted to, I could clear the mortgage today and that property is mine. It's not the bank's anymore. However, what they've done is they've just lost their largest tax deduction, which is the interest cost that they can use to offset the rental income. So the first conversation and why they tend to reach out to us is suddenly they're paying tax on rental income when then in the past they never did. And they're going, what have I done wrong? What have I done? And you explain to them, you just lost your biggest tax deduction. And Aussies love tax deductions. So when you explain to them, you need to back out that money, back at the coast to sort of calculation, rightio, this much money's coming in, this much money's going out, tweak that offset account. And then they go, well, what do I do with the money? Well, then that's part of what we do. We talk about taxable Australian property, non-taxable Australian property. Do you build a share portfolio? Do you buy another house? Do you do both? That's all that conversation. But yeah, don't just go down the route of putting too much money in an offset account, because by doing that, you are going to start generating positive cash flow. And, you know, you've got to pay a third of that money to the ATO and tax. Now, once again, I keep saying, my daughters love money. So, you know, if you don't want that money, give it to the ATO, give it to me. You know, I'll fix that problem up and we'll square it out. But it comes back to just little things that make big differences. People can be so focused on returns and all these sort of things. In actual fact, you know, they're complaining about a 1 to 2% difference in returns, but they're giving 1/3 of their income away in tax unnecessarily. So
that's right.
Keep an eye on your offset accounts.
Absolutely. Really good. And you're right, Brett. It's a very common, well, it's not a strategy. It's just really common for expats to actually follow through on and keep doing it every month, because I think there's also that fear factor. Oh, what can I do back in Australia? You know, what's not going to upset the ATO? Well, I've got that account there. I might as well just throw it in there. And
analysis paralysis.
That's it. Gets completely offset. And then you're like, shit, now I'm paying 32.5% in income tax. What can I do to reduce this income tax? It's a really interesting one, but it also shows that that person didn't have a strategy. Need a strategy. Okay, what's the best way to effectively invest that cash in a good way? So anyway, really good example, man. I think we wrap it up there for today. I think we've covered a lot. There'll be some show notes. Please do click through there. Sue, we'll put a link into that explanatory memorandum. Have a good read. It's a bit dry, that read as well, talking about the main residence exemption. And Brett, as always, thanks for your time.
Thanks, mate. And let's kick it on again next week.
Sounds good. Thanks, guys.
Thanks, mate. See you.